One of the fundamental pillars to financial independence and wealth building is investments. So with the continuously rising inflation, it's no longer enough to save all your funds in a bank account because of its inability to match the hike in cost of living. So this simply implies that cash simply kept in a bank account that generates interest of barely 2% in no time will be eroded by inflation, which currently sits at 3.67% in the United States and 4% in Canada today. As such, you need to understand that investment is an inevitable journey that everyone must embark upon today. So from my years of finance and investment experience, I've come across several individuals that have no clue where to start from or have not done any sort of investment whatsoever, and in certain occasions, investors are seeking to readjust their investment techniques. So in this video, I'll typically be breaking down the steps I'll be taking if I were to start investing today. So my first step I'll take if I want to start investing today is to establish clear goals, guidelines, and as well timelines. So the most important thing in any investment journey is for you to establish your goals and your timelines. Now that's because there are so many, or I'll say overwhelming number of investment avenues today that gets people confused regarding what to invest in, when to invest, and how to invest. So you need to ask yourself a very particular and important question: why are you investing? What are you investing for? And how long would you be investing for? For instance, would you be investing for purposes like retirement, traveling, school, home purchase, or maybe a simple side hustle, or just to generate income? And also, do you plan to invest for the short or the long term overall? So I've actually noticed over time that when I have clear goals on what I intend to achieve with my investment, it helps me narrow down all my investment options to just the limited few I want to consider. So this typically helps to avoid or reduce confusion for me, and of course help me to prioritize my investment options because of my limited resources I have. So the second step for me, which I always typically do, is to determine my investment style. So whenever I decide my investment style, my focus is to determine if I'm going to be a short-term investor or a long-term investor. And again, this depends on the goal I'm trying to achieve or I've set out earlier. So short-term investment comes with several downsides, such as the higher risk exposures, loss exposures, as well as increased taxes for the average investor. For example, day trading could expose an individual to the high risk of loss as well as high risk of returns or potential income. So for long-term investors like myself, we're exposed to lesser risk of losses as well as minimal investment and of course compounding interest over time. So long-term investments will include investing in stocks or ETFs, real estates, and so much more. So my third step is to determine the avenues through which I'll be doing all my investments. So in today's world, we have several investment vehicles, and depending on the country you live in, there will always be government registered investment vehicles as well as non-registered investment vehicles. For instance, for someone like me living in Canada, we have a number of registered savings accounts such as tax-free savings account, which is TFSA, RRSP, RESP, and FHSA, which would typically shield you from taxes that the government will charge. For someone residing in the US, for instance, you have the IRA, the Roth IRAs, the 401k account, and the 529 account, which can shield you from tax. For instance, if you're looking to invest in stock, you might choose to set up this registered savings account or any other non-registered savings account with brokerage companies. Now, the essence of doing this is so you can do your investment if you want to invest yourself. However, if you want a more hands-off approach, you can set up this same account through robo-advisors. So the first step I'll be taking is to establish the amount I choose or I want to invest. So I have a typical rule of thumb that's helped my investment journey so far, and that's simply invest an amount that you will not lose sleep over if things were to go downwards, which means that if you were to lose your funds, you will not lose sleep over those investments. So why do I typically say this? I've met a number of people that invest and do not create room for savings or for emergency funds or for unplanned events or maybe short-term plans. Now, what typically happens is that when these investments start to vary in terms of their valuation, they begin to lose sleep because of tension or the fears of losing their entire funds and being unable to carry out those short to medium-term plans. So ideally, the amount you choose to invest in these avenues I've talked about should be dependent on your overall goal, which you had set out earlier. I set up a specific percentage of my income strictly for investment on a monthly basis. Secondly is that I establish a target emergency fund to cater for unplanned occurrences or situations. The third thing I also try to do is establish a frequency for investment. Now for you, this could be monthly, weekly, it could be bi-monthly, dependent on whatever works for you and your income level. The most important thing for you to do is ensure consistency. So the fifth process is what I call the risk assessment. So at this phase, your focus is to assess what the risk appetite and your risk capacity would be. So if you want to determine your risk appetite, number one, you need to itemize all your investment avenues and the products you have chosen to go for, and then you need to allocate risk ratings on a scale of 1 to 5 and then rank them by order of priority. So this risk allocation will be dependent on the volatility of such investment avenue or products. The next thing for you to do is to determine how much risk are you willing to take in exchange for higher returns. So in other words, how would you emotionally react to losses or variability? This will determine what your risk appetite will be. Now, based on these factors, you'll be able to know if you're a risk-averse person or a risk-aggressive person. So under risk assessment, you also need to determine what your risk capacity will be. So your risk capacity reflects how much losses you can afford to take based on your income level, your ability to recover in the event of a loss, and how much setback this can take you far away from your goals. So number 6 is for you to establish an investment portfolio. So you can typically invest directly, indirectly, passively, or actively in any investment product or activity. If you want to create an investment portfolio, you need to follow this simple step. Number 1, you need to research the products you want to invest in for a start. So the second step is for you to establish your emergency funds in a high yield savings account or high interest savings account. Once you're done with that, ensure to build a diversified portfolio of a combination of both active and passive income streams. So a key thing I want you to note is that ensure you don't invest in long-term funds such as stocks or real estate if you know you'll be needing those funds for short-term purposes such as emergency funds or for a short-term travel or vacation, or you have a specific event that's going to happen within 1 to 2 years. And that's because it might be quite hard to liquidate your funds to meet those needs at the point when you need them. Rather, consider short-term or medium-term savings like GICs, high-interest savings account or high-yield savings accounts, treasury bills, and bonds. So the seventh and last step is for you to establish a periodic frequency for monitoring your portfolio to ensure that the balance is still in line with your overall objective. Now, when you do this frequent analysis and you notice that there is a lot of disparity between your plans and what your portfolio is reflecting in terms of the exposure or the risk variability, it's now time for you to rebalance your portfolio. Now, this might require you selling some investments or transferring investment as the case may be, just to ensure it remains aligned with your overall goals or objective. Now, most important to me as an investor is to avoid herd mindset, where you react to the slightest movement in your investment portfolio. For instance, if something happens and then the stock price is going down, you quickly sell. That's a very big red flag. So let me show you how all of these 7 steps can be practically applied to an average investor. Now, these figures are not real, they're just assumptions. So let's assume an individual that earns an income of say $10,000 per month. By step 1, I'll typically focus on setting my goals. For example, I could say I want to retire at 50 with at least $2 million in investment portfolio. Now, for someone within his early 30s, this is about a 20-year plan, which of course is a long-term goal. You could also set a short-term or medium-term goal, say purchase a home within 1 to 2 years and save a down payment of say $70,000. Now, this is a medium to short-term goal. Now, let's move on to step 2. Considering the objectives I mentioned earlier, it's clear that someone that wants to achieve say a $2 million by 50 years or in 20 years time is looking at a retirement savings account. Now, this simply implies that the individual is a long-term investor, right? However, for someone that's trying to save for a home purchase within 1 to 2 years, the person at that point in time will probably not have a long-term perspective to savings. You would have to consider short-term and medium-term savings tools or avenues such as GICs, high-interest savings accounts, or even certificate of deposits. And that's simply because that these accounts are less risky and have less variability in terms of returns. In other words, your initial investments will remain preserved as long as those funds are in those accounts. So for the step 3, as a Canadian resident, if I was going to focus on retirement as my goal, I'll be looking to invest in special accounts such as the RRSP, the TFSA, before I consider other accounts like non-registered accounts. On the other hand, if I'm looking to save for a home within the medium to short term, I might just consider accounts such as my RRSP, my first home savings account, and of course my TFSA. Now, armed with this account, I can set up a brokerage account to do my self-investment, or I can go for a robo-advisor to do investments on my behalf, or simply just buy ETFs with these accounts. Step 4 is where I typically determine how much I want to allocate to my investment. Assuming I'm using a 15% threshold for my investment, that's to say 15% of my $10,000 income, which will bring me down to $1,500. This is how much I'll be investing on a monthly basis. Now I have to typically set an auto pay so that it goes directly from my account on a monthly basis at a specified date into my investment account for me to do my investments. Also on that is setting up an emergency fund. Now I always recommend that you set up an emergency fund of 3 to 6 months. Assuming we go for a central point, say 4 or 5 months. Now 4 times $10,000 is about $40,000. Now remember, you might not be able to save all the $40,000 immediately, but have a plan on when you want to save up that amount over time. Now beyond all of this, remember my aim at this point, if I was doing a long-term retirement, is to save $2 million at the age of 50. Assuming I'm 30 years today, which means I have 20 years, if I use my compound interest calculator, I can work back to see a reasonable return, say between 7 to 9%, and that will determine how much I need to invest on a monthly basis. Now remember, I already set a 15%. Now when I do that 15% and I'm noticing a shortfall between what I expect to invest versus what I plan to invest, I might have to up my investment on a monthly basis. Of course, dependent on if I can afford to do this or not. So number 5 is the risk assessment. So typically what I do is to list all my investment products or potential investment products and the maximum I'm willing to lose on those products. For instance, if I had 5 products and each of them, let's assume an ETF or stock, I may just state, say $5,000 or $10,000 is the maximum I want to put on this account. And that's to say, if I were to lose this money, I'm not going to lose my sleep over it. I'm not going to be too tense over losing that fund. Now that becomes my threshold, which I must not exceed. Now remember, it's not cast in stone. These thresholds can be changed over time as your financial capacity continues to increase. So the 6th step, like I said, is where you want to build your portfolio. Now what I do is that I research the stocks I want to invest in. Now if researching stocks is not your core competence, right, and you don't want to do it yourself, you can simply go for exchange traded funds. We don't require too much research or stock picking skills or knowledge. But for me, I do my analysis on each of those stocks I want to invest in. I build a watch list, and of course I consider what other analysts are talking about those various stocks, and based on that I develop a watch list and I choose when to invest in each of these stocks as the time goes by. So if you're interested in getting this my watch list of stocks which I'm considering to invest over time, feel free to drop a comment in the comment section and I can share my watch list with you. And like I said earlier, emergency fund is something I already have established, which generates its own form of interest to me. Apart from that, I ensure to diversify my investment portfolio. I've considered investment in businesses and side hustles. I have investment in stock market, real estate, intellectual properties, as well as affiliate marketing. Now these are just ways for me to diversify my income sources. So the last thing which I typically try to do is continuously monitor my stock portfolio to ensure that they're doing well. And of course, I try to categorize them into, those that are high performing and those that are low performing. Of course, this also helps me to determine what my next line of action will be regarding any of these investments. Alright, I hope you found this very insightful. If you have any questions regarding any of these things I've explained, feel free to drop your questions in the comment. I'll do my best to respond to as many as I can. Most importantly, don't forget to like, share, and subscribe to this channel so you don't miss any of my content subsequently. Alright, thank you and have a good one. Bye.